every quarter, Wall Street holds its breath. Investors, analysts, and CEOs alike are glued to earnings calls, waiting for the numbers. But financial statements aren't just about reporting the past. They reveal a company's strength, strategy, and future potential. Warren Buffett doesn't invest in stock prices. He invests in businesses, and financial statements tell him everything he needs to know.
Our special guest this morning is the chairman and CEO of Berkshire Hathaway, Warren Buffett.
It's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything.
Is the company healthy? Is it growing? Is it burning cash or printing money? Let's break it down. Financial statement analysis isn't just about absolute numbers. It's about context. A company might report $1 billion in profit, but is that good or bad? You need to compare it to, let's say, historical performance. Has profit grown over time? Industry peers, how does it stack up against competitors? Market expectations, did it beat or miss analyst forecasts? Let's take an example of Amazon versus Walmart. Now, Amazon operates on razor-thin margins, reinvesting heavily into technology and logistics. Walmart, on the other hand, thrives on efficiency and scale, maintaining steady margins.
The competition between these two wasn't always obvious. Amazon built its everything store for the online shopper.
Where they have really made a mark is by appealing to people with fast delivery for almost anything you can think of.
Walmart designed its supercenters for the in-person experience, putting stores near American homes and promising them everyday low prices.
Walmart, always low prices. Always.
A majority of retail sales still happen offline, but as online sales have grown each year, so too has this head-to-head competition.
The American consumer is really fickle. You can't just get people these days by offering the lowest prices. You have to offer them the lowest prices and a whole range of other products and services, and I think the biggest players are trying to do them all.
Their financial statements reflect two completely different growth strategies. Wall Street lives and dies by financial ratios. They turn raw financial data into actionable insights. Let's look at three key categories. So first, profitability ratios. Is the company making money efficiently? For example, Apple's 40% plus gross margins show why it's one of the most profitable tech companies in the world.
This August, Apple became the most valuable publicly traded company in the world, overtaking Aramco as its market cap soared past $2 trillion for the first time ever.
And that is a $2 trillion milestone.
Shares of the company increased nearly 60% this year. I mean, it really is history.
Next, we've got liquidity ratios. And the question is, can the company meet short-term obligations? For example, Lehman Brothers in 2008 had a liquidity crisis.
On the day's trading, one of the largest point drops in history. NASDAQ was down more than 81 points. S&P lost 59 points in today's trading. All of this fallout from what happened last night in New York as Lehman Brothers filed for bankruptcy protection just after midnight.
Lehman Brothers staff arrived at work in London this morning to be told the bank had been put into administration.
It is disastrous, but I think people are experienced enough and professional enough to take it on the chin.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
They were over-leveraged, and when confidence collapsed, they had no cash to cover their debts. The third is capital structure ratios. How risky is the company's financing? For example, early on, Tesla relied on debt financing, issued convertible bonds to build those gigafactories, invest in R&D, and build those electric cars.
And it's worth perhaps just highlighting the sheer scale of the gigafactory. And why do we even call it the gigafactory? It's because It's actually going to be, it's not just going to be the biggest lithium-ion battery factory in the world, but it'll actually be bigger than the sum of all lithium-ion factories in the world.
Each ratio is a lens into the company's financial health. A company can report massive revenues but still be unprofitable. Profitability analysis looks beyond the headlines. For example, Uber as well as Netflix. For years, both Uber and Netflix operated at a loss, prioritizing market dominance over short-term profits. Traditional investors were skeptical, but venture capitalists understood that customer acquisition and scale mattered more. The Wall Street red flags are when financials hide the truth. For example, WeWork burned billions in cash, but its financials were framed to look like a tech company, not a real estate business.
The worst case scenario is that it gets pegged as a real estate company.
Okay.
In which case it would be about 20 times overvalued than its last private round of $47 billion.
Okay.
For example, Kodak failed to adapt despite strong financials in prior years, proving that looking only at past numbers is dangerous.
Filed for bankruptcy protection while seeking new ways to grow as a viable business.
As a result, Kodak filed for bankruptcy in 2012. Today, when people think of Kodak, they either laugh or express disbelief. Kodak is still around, but they are now an example of what not to do.
Financial analysis isn't just looking at what happened. It's about predicting what will happen next. CPAs are trained not just to read financial statements, but to make decisions based on them. Should a company expand or cut costs? Should it raise debt or equity? Should it acquire a competitor or reinvest in R&D? By mastering financial statement analysis, you become a strategic advisor, not just an accountant. Wall Street rewards those who understand the story behind the numbers. And as a CPA, you don't just analyze the past, you help shape the future.